Hello friends, today we will discuss in brief what happened in Indian interest rate market over last quarter. Indian interest rates witnessed a downward pressure overall due to some domestic as well as global factors. From a global perspective, we had US FOMC in which US FOMC showed confidence on US economy. In fact, even in light of NFP data, non-farm payrolls data, which was quite vibrant, and also because of inflation data, which is quite stubborn, we saw US holding its rate and maybe it will cut rates sometime in future. But the main reason of holding the rates is also because it is having some downward pressure on inflation. But looking at other global central banks like ECB, Brazil and Canada, who have started rate cuts already, we think that even US FOMC or Bank of England, because of improving factors like inflation and employment factors, we will see rate cuts by third or fourth quarter of this financial year. From a commodities perspective, we had commodities like crude, gold and copper going in different directions. In fact, gold improved a bit on China buying gold due to de-dollarization news. Crude in beginning of the quarter had some volatility because of geopolitical escalations between Israel and Iran, but later on because of softening issues, we saw crude prices settling down. From a copper perspective, we saw a major movement in copper as far as industrial commodity goes because of some disturbance at the mine level. From a domestic perspective, we had RBI monetary policy in which RBI maintained its stance on withdrawal of accommodation and did not tinker with rates. In fact, on the inflation front, they maintained the projections around 4.5, and on the GDP front, they increased the projections from 7% to 7.2%. In this financial year. Other than this, one of the major factor was the voting pattern, which was say 5-1. Right now it is around 4-2, which means that last time there was one of the MPC members who was expecting rate cut. Now there are two members who are vouching for rate cuts in near future. So that's an improvement from a rate cut view perspective. Post policy, we saw rates in Indian markets having a downward bias mainly because of two reasons. One is obviously geopolitical tensions were not escalating, which gave a lot of comfort to the market. Secondly, we also saw a huge dividend from Reserve Bank of India to Government of India, which also created a view that it might help a government managing its fiscal deficit. From an inflation perspective, we expect that inflation in the current range of 4.5% to 5% over medium-term horizon. In next couple of months, because of base effect impact, we will see inflation coming down. But things like delayed monsoons or heat wave and also the recent tariff increase by telecom industry will have some bit of negative impact as far as inflation is concerned. And hence we feel that inflation over a period of time might move in the range of 4.5% to 5% only. From a liquidity perspective, clearly we saw liquidity getting into a positive zone from a negative zone mainly because of government month-end spending and some liquidity infusion because of GSEC maturities. Going ahead also, we have budget in which we might see some social or capital expenditure done by government and which will result in liquidity improving over a period of time. Because of the liquidity improving, we expect that shorter end of the curve, especially the curve up to 1 year, might see some steepening in the overall levels wherein the shorter end will move down over a period of time. Finally, considering all the factors, what we feel is from an Indian interest rates perspective, the outlook is that going ahead, we expect there to be a downward bias as far as interest rates are concerned, and that's mainly because of improving liquidity situation or stable inflation, or for that matter, even global central banks going in for a rate cut over a period of time. So from a timing perspective, we feel that either fourth quarter or late third quarter might be ideal for Reserve Bank of India to look at interest rates going down. And from a fund perspective, clearly investors who have liquidity view and considering the improving liquidity situation over a period of time, I think funds like money market, ultra short term liquid funds are quite suitable for them. From an investor with a 6 months plus investment horizon, I think given the interest rate view both globally and locally, one should look at having a good exposure into medium to long duration fund. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.